Hey, welcome to the Closing Beat, everybody. Happy Thursday. Hope you're having a great day here today. We're financial advisors here at Jazz Wealth. This is just a quick class that we do to cover the stock markets, let you know how things are going. The good, the bad, and the ugly. A little bit of ugly lately, so we're going to be sure to cover that along the way. Tonight, if you're one of our customers, we're a teaching firm, by the way. We do classes every single week, and this week's class is going to be using the dojo. We're going to go through and show you analyzing the markets real quick. How can you just kind of get a quick look and see how things are going on, but see the entire market all in one shot and be able to sort of scale through so that you know exactly kind of how I go through what I go through as well here. So be sure to check that out. You have an email in your inbox if you're one of our customers. Now, I love when the markets fall, so I'm like really excited, but it makes for a moment of teaching for me, right? So like I say, we're a teaching firm. I love when the markets fall because it allows me to teach someone who now is emotional, right? Whether you like it or not, you get emotional when the markets fall. It allows me to teach you something new and really kill the emotion, right? That's my job, is to keep you unemotional. And I've been complimented at it, saying I'm pretty good at it. So I wanted to share one thing with you today. It was a conversation I had with somebody that called. You could schedule a call right on our website, and I try to call everybody. So this will help everybody. So I'm not just telling stories here. It was a new investor, not going to be a customer, not an existing customer of ours. He said, I just got started. I've been investing. I love it, right? I don't need your service because I really love this. I want to learn from you. I watch all the shows. So I said, okay, great. Well, what can I help you with? And he said, well, I'm scared, right? I just got started. The markets are falling. I sort of think this is going to be a big deal. All of a sudden, he was emotional, right? That happens. A lot of people go through that. No big deal. And so I said, well, how long have you been investing? He's like, well, two weeks, right? I've just got started. I got my IRA set up. I'm picking out my investments. He's a little bit nervous. And I said, okay, well, I'm going to give you a piece of advice, a statistic, and then you tell me what that does for you, right? Because as you learn more about the stock markets, you're going to pick up all these things in your head. You're going to remember the sell in May and go away and Christmas time, Santa Claus rally, things like that. And you're going to pick up more and more, and then you're going to do something with it. So let me give you a piece of advice, and I'm sharing this for everybody as well. And you tell me what it does for you. I said, every single year except for 2 years, 1995 and 2017, the markets fell 5% or more. Every single year besides those 2 years, the markets have fallen 5% or more at some point. And I said, what does that do for you? And he goes, that sucks, man. I don't like that. And I said, well, but think about it. If you know every year, statistically, besides the two, every year the market's going to fall 5% or more, you now are ready for it. You have prepared your mind. You know it's coming at some point. Now the choice is, do you do something about it, or do you kind of cry about it and get a little bit nervous, right? And over time what happens is people get excited and they look forward to that 5% drop. Now last year it happened to happen twice and it was 20%. So sometimes it can be a lot more than 5%. But the concept is, now you know that the markets will do that, right? It is super odd if they don't do it. And so that was able to help him out and just kind of send him on his way. I love that, man. I love being able to teach somebody and let them kind of go through life. Now he's not going to be a customer, so there was nothing to gain from that. But who knows, maybe a little goodwill goes a long way. So that was my short story to start the day. Hey, it's May, right? May is a tough month for the markets. May through October, historically a rough patch for the market. This May, by the way, is the worst start to the month of May all the way back almost 10 years now. You got to go back to the flash crash, which was May 6, 2010, to find a May that started worse than this one. So we're not off to a good start here if you follow May. However, if you're one of our customers, last week's class actually showed you exactly when, if May recovers, exactly when does it do it. Not from my opinion, but from historical statistics there. So be sure to check that out. Anyways, you got President Trump at a rally here in Florida last night saying China broke the deal, man. Those were his words. And that sent the futures markets lower pretty sharply overnight. We opened up today, we were down about 400 and some points on the Dow. Now look at where we closed, 140 points in the red. That's not too bad, right? What happened? Why all of a sudden the markets rally? Well, look, they're playing this market. The White House knows what they're doing. And Trump came back out and said, I got this beautiful letter from President Xi. Must have been overnighted or something, right? Like, how'd the letter get here so quick? What mailing service is that? Because I can't order something from China that fast. He goes, I got this beautiful letter. It's awesome. And he says, we're going to be friendly. We're going to work things out. Well, in the middle of the day, look down on the bottom right-hand corner of your chart screen. You see how the markets were down and then went, let's go back higher. That brought the Dow higher off lows by 200 points. An incredible little rally there on that news. However, we don't have a deal, right? Tomorrow's the deadline. We're expecting tariffs tomorrow. So investors are still pretty cautious here in the short term. And I think that's okay. So if we take a look at the S&P 500 today, the big focus by technical traders is this blue line. It's the 50-day moving average. Everybody likes to see that that holds. It's sort of a midterm measure of a trend to say, well, okay, it's been a little sloppy here for the last couple weeks, but overall, the trend is still intact. And so technical traders like to use that. We closed above it. That's a good thing. And even after hours, we're moving a little bit higher off of it. So positive things there. Nasdaq, same thing, held the 50-day moving average. The trend is still technically intact. The Russell, I'm sort of getting tired of talking about the Russell, but it did hold the 50-day, although a lot of people would say, what in the world is this? This is not a clean trend when you compare it to like the S&P 500 and things like that. So what does all this mean here? What does this tariff stuff mean? I thought I'd kind of take a quick second to go over it. Higher tariffs, if they're placed on companies, more goods starting tomorrow, it means higher costs, right? China doesn't pay for all of that. We're going to pay for some of that as well, right? So for companies, it means higher costs. Now, if you've been following for a while, we've gone through the earnings of every company as they've come out, and you notice that a lot of these companies have been saying, we're able to charge more. So it's not such a big deal. If your costs are more, but you're able to charge customers more and they will pay it, then okay, not a big deal, right? So that's the first thing. If the companies have higher costs and customers won't pay it, meaning you won't pay $12 now for a meal at Chipotle. You're starting, not that they're involved in this or whatever, but you won't pay top dollar for a new phone, new technology, things like that are all have these tariffs on them. Now it becomes a problem because if a company has higher costs, well, then that means their earnings are going to be less overall, right? Cost them more to get the product to the customer, and when the customer buys it, there's a smaller profit margin there. So all of a sudden, companies will say, well, we didn't make as much as we thought because of these darn tariffs, right? If companies have less in terms of earnings, then that means what? The company's not worth as much as it is right now, and stocks will sort of sell off like they are. So what you see with the stock market pulling back here is people going, okay, if tariffs are really going to happen here, what is the new value of the market? It's not worth what it was because now we know there's going to be higher costs, which means less earnings. And so now people are adjusting their model saying, well, we think the market's value is now somewhere lower, clearly close to 5% lower. So that's that in a nutshell. Now, stocks like Dollar General, we kind of talked about this before, they already announced that they're planning on tariffs at 25%. They're operating themselves as if things are already at 25%. And look at the stock here, still very much in an uptrend, not too bad. We mentioned Dollar Tree not doing that. So a steeper sell-off there because they got some adjustments to make. So that's just a quick sort of, I don't know why I'm like doing so much of this stuff today, but you get what I'm trying to say there. Higher or new tariffs or higher tariffs means lower or higher costs, which means lower earnings, which means stocks are worth less. That doesn't mean they're worth zero, right? It means they're just worth less than where they're at right now. And the magic sauce to the game is to try to figure out what the new, actual value of a company is. Meanwhile, over in North Korea, I don't know if anybody saw this. Like nobody wants to talk about it. They've fired off their second ballistic missile. We just sent we sent a U.S. team over there, not like troops or anything, but a negotiating team. We sent them over to South Korea. And they're firing off missiles. This is a second one in less than a week. So I have a feeling if we weren't talking about trade, we'd definitely be talking about that. And so would President Trump, by the way. He'd be all over that. So that's, kind of the news in a nutshell here for the day. Let's go through individual sectors. You can see at the bottom of the list here in the dojo, semiconductors. Right? They're right smack in the middle of this fight between China and the U.S. because a lot of their revenue comes from China and overseas as well. So semiconductors having another bad day here, down another 1 1/3%. In addition, though, I would add Intel. Intel's had a rough go of it here. We'll cover that in a minute. But Intel certainly not helping as well. If you look at tech stocks in general, I'll use the XLK. A lot of weakness in that one. Still holding the 50-day moving average and everything, but those guys are going to get hit too with these tariffs. So just so you know, for our customers, we follow everyone, right? So it not necessarily like Twitter or whatever. But we follow Goldman Sachs, JP Morgan, Raymond James here in town. Anything that they tell their customers, if it's worthwhile, I'm going to tell our customers, right? So all the things that Goldman Sachs sends to their high net worth customers, we get that. We got an eye on that as well. And so actually Goldman Sachs sent out this note and they said, hey, tell you what, and now it's public, you can look it up anywhere. But they sent it out the other day saying, you know what, if this tariff thing is going to be an issue, you want to be in the service tech space versus the product tech space. And they went through this whole thing. They used Apple and Microsoft as an example to say, look, Apple's got more of a problem than Microsoft, right? So if you're looking in that software or software as a service category, that's how you want to play tech, not necessarily products like chips and phones and semiconductors, things like that. So it was a really cool thing. I just thought I'd share some of that with you if that helps you out in any way. Anyways, tech stocks, you're still higher by, they pulled back by 7% here over the last 2 weeks. Still, obviously, very much higher in the long term here. So you can afford to see a pullback. Not too many people are too concerned. On the top end of the list, you got real estate, just kind of floating around near highs. Utilities, a little bit of a recovery. This is that sector we've been sort of highlighting as what happens when a sector becomes not only overbought or overpriced from a stock perspective, but also overvalued. We've been going through that over the last couple weeks to help you out with that. So I hope that helps you in some way. I want to point out fund flows real quick before we get into the stocks. Each week there's a report that comes out of the money coming in and out of mutual funds. And so mid-cap and small-cap mutual funds are still seeing the outflow. All equity mutual funds, people are moving money out of them, which shows people are getting scared again after just such a little bit of a drop there, although it's stabilizing. Also, the target date funds clearly are the leader of this. They've been moving money out of the equity funds and slowly moving them back into bond funds. Last week, the high yield bonds, high yield bond funds, they saw their biggest increase in new money coming into it since second week in March. So looking pretty good there. Again, it's not that people are moving towards bonds, it's that these target date funds were taking a lot of risk. I've given them a lot of grief on some of our videos, and now they're saying, okay, we can go to some bond funds and have that be a respectable investment to balance things out. The sharpest uptick in new money coming into these funds was in the total bond funds, so those big wide packaged funds. I don't know if you care about that stuff. I like looking at it, so I just thought I'd share it with you, but let's go over to individual stocks here. In the S&P 500, this is different, you had 12 names make new 52-week lows. Remember, we were just talking about 52-week highs. You got 12 of names making new 52-week lows. A lot of them were sort of weak already. I'll point out names like Macy's and Alcoa. Oh, I typed the wrong symbol. Macy's and Alcoa. There we go. Coming up for you. Hitting new 52-week lows there. Limited Brands is another one that broke some new lows. Notice how these are already stocks that are weak. What have we been kind of talking about here? When the markets get weak, the stocks that are already weak, they are the first ones to go, meaning the first ones to fall. So that's playing out. If you've been following along here for a little bit, I'm not an I told you so guy. Remember, I always say, I want to tell you ahead of time. I know many of you are looking at these weak stocks, and that's what I kept pointing out. Relative weakness to the market, you got to be careful there. A couple names that are also in the Dow, 3M. Holy cow, like that's a sharp sell-off. That's new lows for the Dow. Well, new 52-week lows for 3M. And Dow DuPont, also new 52-week lows, happens to be a Dow stock there as well. That's the bad news. Good news, Disney. Although it was a little bit lower today, Disney had pretty good earnings. I mean, all around, we covered this yesterday, good earnings. One little concern, and this is to me a little bit overblown, so I think that's why you see the stock not really moving a whole lot. They're spending a lot of money on that Disney Plus. They call it the direct-to-consumer segment of their business, and they're going to have to. They're just going to have to spend more money, so it's understandable that they did. That segment of their business currently operating at a loss, and probably will stay that way. Intel down 5% on the day, carrying over from yesterday's late day sell-off, if you happen to pay attention there. They did a conference and basically just talked about their revenue guidance going forward. It wasn't good. It wasn't good, the stock resetting on that news there. Also, it was downgraded today by BMO, just citing margins overall. I mean, it's a whole thing if you want to watch it. Stamps.com. Do you look at Stamps.com? I don't really look at this one here. anymore. It's had a sharp down day, obviously. This one's got a major reset going on here. This is officially now. If you look from last quarter to this quarter, right? How did a company report earnings last quarter? How did they report earnings this quarter? If you compare that to any other company on the planet going back to 2000, there is no other company that's ever reported 2 consecutive quarters of this bad of earnings there. Last quarter, 57.8% decline in earnings. This quarter, 52.3%. You can't find one company that's performed worse. Look at small caps, large, whatever you want to look at. That's horrible for them. They got to work it out. They will work it out, I think, but it's they lost their they're not working with the U.S. Postal Service directly anymore. So that was kind of the whole business, wasn't it? It's kind of a tough one to swallow there. Costco there, they reported same-store sales better than expected. This was yesterday. I'm just bringing this forward to today. Same-store sales came in at 5.5%. Everybody was expecting 4.4. So shares higher today. That's a beast of a stock. It's been doing really well there. And lastly, everybody's focus, Uber. You got Uber coming public tomorrow. Now, be careful here. They've been saying all day, it's 5 times oversubscribed, meaning there's a lot of interest. No, it's 5 times oversubscribed, but if you compare that to the Alibabas, the Facebooks, go back to Google if you want, it's actually way below average. And I think you see that. I don't mean to beat up on them so much. I know I haven't said much nice all week, but if you look back, really being 5 times oversubscribed for some of these big-time, high-publicity IPOs is not normal. 10 to 12 times is more the average. So 5 times oversubscribed is them just trying to say, yeah, look at us go. And interestingly, if you follow along, they're pricing at 45, which is at the low end of the range. So there you go. I hope that helps. And I don't have a chart to show you guys there, so I'll take any questions you have, try to help you out, and we'll move on from there. How do you feel about steel with infrastructure? I know a lot of people are trying to make that move towards infrastructure there, so I can understand that. Also, payday for dividends. You got Granger, ExxonMobil, Apple, Hewlett-Packard, and Capital One all paying out dividends. Well, it's X day, by the way. It's not the day you get paid, but it's the day that if you own the stock, you will get paid. So something to keep an eye on there. It is raining, isn't it? It's raining really hard. You know, it's funny. Last week for our class on Thursday for our customers, it started raining. I mean, like hailing, like just incredible rain there. Oh, it was crazy. It was incredibly crazy. That's the downside to having a big old studio instead of some 12th floor office space somewhere. Well, anyways, that's good timing because I really don't have anything else to share with you. All eyes on trade and Uber tomorrow, a day you don't want to miss for sure. We'll be back then. I hope you enjoyed. We'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.